Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. Beating the benchmark is the holy grail of active management, but it's notoriously difficult and rare. Still, against the odds, a handful of portfolio managers do outperform the index, even if only fleetingly.
From stock-picking stars and lightning-fast quants to deep-dive research teams, we explore the tactics funds use to gain an edge. And in today's dumb question of the week, what is the information ratio and why does it matter? All right, let's get into it. So today, Roman, we're planning to talk about active funds. Now, I don't know what I'm going to say because I don't remember the last time I bought an active fund. I think I internalized the fact that passive is better a long time ago. So why do you want to talk about them?
I think it's always good to reevaluate your beliefs, and I think it's certainly interesting to look at some funds which do seem to be generating some outperformance, and also how they could generate outperformance, because I think the pendulum's very much swung from when I first started Pensioncraft, when a lot of investment in the UK was actively managed, unthinkingly so, to a world in which the vast majority of money is flooding into passive funds. So perhaps it's time to rethink why that's happening and whether we should at least consider active funds as part of our investments.
But I feel that before we do that, we should remind everyone why so much money flows to passive. And it is based on evidence, isn't it? Passive funds tend to outperform the vast majority of active funds, both in the short term and especially in the long term.
Yeah, look, for newbies who've just come into the investment space, you look at these passive funds and they seem to be really stupid. You know, they just buy whatever is in the index. They buy everything sometimes. And yet fund managers who try to beat that index by weeding out the really awful stocks and buying the good ones, I mean, that should be pretty basic, shouldn't it, to do that? They underperform the really dumb strategy, which is to buy everything. And on the face of it, that is utterly bizarre. And really surprising, even for people who've been in the markets for a while.
It's one of the few industries where the experts really underperform amateurs who just do the right thing and buy everything, which is bizarre, like you say. But then that is the evidence. Every year, S&P Global publish the SPIVA report, the index versus active report, and it gives a scorecard comparing all the active funds, all those clever stock pickers against the benchmarks, and inevitably, something like 80 to 90% of active managers underperform the benchmark in any 1 year. And the longer you make that time frame, whether it's 10 years or 20 years, you get closer and closer to the fact that zero active funds outperform.
So I think that's one of the problems. The vast majority of active funds underperform a passive benchmark or an equivalent benchmark. And the evidence for that is pretty overwhelming. Now, for the funds which do outperform, I think the difficulty as an investor is finding those ones which do outperform in future. Now, we can look at the past, of course. That's how we gauge whether they'll outperform in future. And the problem is that once you've identified success, often it fades. So you might think that outperformance persists. If you've got a good fund manager and they're beating the rest of their industry, the rest of that kind of asset group, whatever their style of investment is, that would persist into the future. If it's just luck which has made them outperform, if it is just monkeys and typewriters, and statistically just some fund managers float to the top of the tank, well, if that's the case, then you'd expect the outperformance not to persist. So what SPIVA also does, which is really shocking, is they have a persistence scorecard where they say, look, we'll find the best performing funds over some period of time, and then we'll track those funds, very carefully taking into account the funds which go to the wall. So that way you don't have a survivorship bias. And then we'll say how many of those carry on outperforming in future. And then they compare that to chance. What if you just flip a coin? So for example, when they did that in Europe, if you look over a 5-year period, the chance of carrying on outperforming compared to a coin flip, well, the coin flip would be 6%. And in equity and fixed income funds, the remaining outperformance is 6 and 8%. So very close to the coin flip, which suggests that if there is an outperforming fund in equity or in fixed income, it is pretty much a matter of chance, or at least it looks like that. So this prevents a huge problem for investors trying to identify the outperforming funds. If you do find one that's outperformed over some period of time, will it persist into the future? And the evidence is no, it won't.
Yeah, I mentioned at the top that I don't remember the last active fund I bought. And it all comes back to the idea of efficient markets, doesn't it? You can't really beat the benchmark very easily. And I've never had much confidence in myself to pick stocks. And I think I have even less confidence in my ability to pick other people who can pick stocks. It's like one step removed, right? And they're charging a fee.
And that's another problem, which is that actively managed funds often have higher fees. And even if they do outperform, if the fee's too high, it gobbles up that outperformance. And there is some evidence that active funds do outperform. They do generate what's called alpha, which is the percentage outperformance relative to some benchmark. So they do generate a little bit of alpha, a sliver, which is then gobbled up by their fee.
And yet, despite everything we've just said, despite the mountains of evidence, people still do buy active funds, and there's loads of them out there. And I think we should be grateful that there are, because someone's got to be picking stocks and making the market work so we can free ride on it. But as you said, some of them are going to outperform, at least in the short term, and a very, very small number might generate long-term persistent alpha. How do they go about doing that, or at least trying to do it?
Well, many are the ways in which they try to beat the index. And it is difficult. It is very, very difficult to use these methods to outperform, as we've seen from the statistics. Or to quote the Bible, small is the gate and narrow the road that leads to outperformance. Maybe that's not quite what Jesus said, but you get the idea. Broadly, you can split it into two groups, top down and bottom up. Now, top down is when you look at macroeconomic variables and then you try and find investments which will do well in those environments. And if you're right about the future macro environment and also the effects on stocks and bonds, then you will outperform. The second approach is bottom up, where you look at single stocks, you look at their fundamentals, you look at where they sit in their industry, you forecast their profits, you talk to the management even, and from all of that information, you decide whether to buy that stock and have more of it relative to other investments or relative to a benchmark. And again, if you're right about the direction, you will generate outperformance, you'll generate alpha.
I think that second one is what most people think of with active funds, at least to begin with. You've got some genius sitting in a room making high conviction bets on stocks that they like. And what they're really going for there is a concentration play. They might pick 20 to 50 stocks in their portfolio after a lot of research, hold them for a long time usually, and you better hope they're right.
Now, inevitably, companies have to market these funds. And if you're marketing a person, a personality, someone who's got a big personality, then it's easier to market the fund. So finding stock picking stars is the way that most fund managers go. In the UK, we've got Terry Smith. Historically, he's been a very good stock picker, not so much recently, but we don't really have many Warren Buffetts in the UK.
And I suspect the usual career path for a stock picker, the typical person, will be they come in, if they're lucky, they make a bit of a splash, they do well, they gather assets, people give them their money, and then over time they do less well because the luck fades and they're cast aside like Neil Woodford or perhaps Cathie Wood.
But not before they bag very large fees and also retire. So, it's not a bad story. It's not a bad outcome for the fund managers. We shouldn't feel sorry for them. If they are failing to do their job, which is true in many cases, then I don't think they should be rewarded so heavily.
But the point is that Warren Buffett is extremely rare. To have that long career where he beat the index by a huge amount over like 60 years. Although a lot of that did come in the early years.
As did Neil Woodford in the UK. He had a lot of outperformance for a long period of time. As did Bill Miller, another active fund manager in the United States. He beat the S&P 500 for 15 consecutive years, from 1991 to 2005.
That's a hell of a monkey at a typewriter.
But look, there are lots of fund managers out there, and that's a lot of monkeys. So eventually one of them is going to do well. I'm not saying that he's necessarily a monkey. He was doing his best. And I think that's the other shocking thing, which is that the active fund managers are highly intelligent. They're very well resourced. They are trying to do their best and they work really hard at it. And yet we have this incredible history of failure.
From all my conversations with you in the past, Robin, I think it's fair to say that you're quite skeptical of this style of active management where it's a genius or a supposed genius sat in a room thinking hard and choosing 20 stocks.
Yeah, because eventually they come unstuck. Terry Smith did incredibly well for a long period of time, and then he's just had 5 years of abysmal performance. Because whatever their style is, whatever their method, eventually it's going to go wrong. And eventually they're not going to be around. So I think that's the problem, which is about the sustainability of the outperformance. The source of ideas, the approach to investing may not work in the future. So that's the real problem, I think, for active fund managers and for people trying to find them. Once you back the horse, either the horse leaves the stable and you have to follow them to some other fund, or the horse is not going to be around.
So we've done horses, we've done monkeys. What other animals are going to be in this zoo today? It seems to me that with these star stock pickers, you either die a hero or you live long enough to lag the index.
Yeah, that's a good way of describing it. And that's certainly true to history, in many cases at least.
So if we're saying that maybe that's not the way to go, or if you do go that way, you've got to be extremely lucky, what are the alternatives? What else do active funds do to try and beat the index persistently?
Another bottom-up approach to stock picking is to look for special situations. For example, it might be mergers and acquisitions. Some companies just look very cheap. So if you accurately predict that they will be the target of an acquisition, and the acquisition price is above the current share price, then you could be looking at very large gains. So this is a type of approach to active investing where it is special. You do have this small group of stocks which could potentially outperform significantly. And that shifts the odds in favor of the fund manager.
And there's lots of different event-driven styles of investing. They've got M&A, like you say. Also might be spin-offs. Like often if there's a company is big and it does lots of different things, there might be a smaller unit within that, which is really promising, but kind of dragged down by the rest of the company. But if they decide to sell that unit, maybe it unlocks some value. So a lot of fund managers will look around for these sort of hidden nuggets of gold that are being dwarfed by a horrific pension deficit or something.
Yeah, or it could be restructuring the debt or a whole bunch of events which could lead to upside. So that's another bottom-up approach. Another one is that if you are a very large fund manager, in the sense that you've got lots of assets under management, you've got a lot of clout when it comes to shareholder votes. Because if you own a large proportion of the stocks, you get a lot of votes in the shareholder meetings. So these are called activist investors, where they buy a big slug of the stocks and then they hold the management to account and they say, look, you're running this company incorrectly. I think you should do A, B, and C. And of course, if they're right, then they can improve the returns of the stock.
So this is almost the most active of all the active approaches. It's getting your hands dirty, right? It's buying a big share of the company, maybe trying to get board seats, outvote the current board even, and kind of right the ship and then reap the rewards.
Yeah, and if they're correct, then, it could work. But again, I think the problem is that it often doesn't.
And the problem is it's often controversial and they're hated by some of the other investors and the current management.
That's right.
But to me, that is kind of what capitalism is, right? Put your money where your mouth is.
Yeah, at least they've got skin in the game. So in this case, if they are right and they shake up the management's decisions and they shake up the company, then they'll benefit directly. So there is a strong incentive to be right, but that unfortunately doesn't make it so.
So we've talked a lot about the bottom-up approaches. What are some of the top-down approaches that active funds might take on the road to outperformance?
Well, here it's about taking economic forecasts. And again, this is a guess about what's going to happen to macroeconomic variables in the future. So that's usually to do with growth, inflation, and interest rates. Those are the blessed trinity of top-down research. And then based on those forecasts, you see which asset types will do well. So let's say that you think that interest rates are going to go up in the US relative to the rest of the world. What would you buy? Well, you might buy the dollar. That wouldn't be working so well right now. Or you could do an interest rate play where you look at US treasuries and say UK gilts and trade one versus the other. Or you could do it through stock markets. There are multiple ways of implementing your idea and essentially harvesting the outperformance if you're right. So I'd say half the skill is forecasting what's going to happen to macroeconomic variables. The other half is to know how to implement the trade based on that forecast. And of course, both have got to be right in order to outperform, which makes it even more difficult, I think. It's very rare to see consistently outperforming macro funds.
And is this more a field that's dominated by, again, a lone genius sitting in a room? Or is it more data-driven, quant-driven stuff?
I'd say the single stock stuff is generally more quant stuff, where either it's a computer algorithm which does things very quickly, or it's a team of quants choosing the stocks. Macro tends to be more personal, so it's usually a macro strategist or a team of macro strategists which make the forecasts and decide on the trades. And often, if it's a macro fund, it'll be something which is for high net worth investors. Often it's in the form of a hedge fund. I don't know why that is, but yeah, hedge funds tend to be the ones which have the top-down approach. Maybe it's incomprehensible, which is why retail investors like you and I wouldn't go for macro funds. And also, if you're a hedge fund, you can go pure long-short. In other words, you're market neutral. If you've got a retail investor, they won't be able to buy those funds because it's got too much leverage in it. When you short stocks, effectively it increases your leverage. But certainly many hedge funds are long-short. They're market neutral. If the S&P 500 goes up or down, they don't care. They just make money if their longs beat their shorts.
I think the other way that retail investors think about a top-down approach is that they'll decide on a theme or a factor first, and then it will sort of trickle down and be implemented by buying the right assets underneath. So it could be things like an ESG tilt or some theme they think is going to be the future, whether it's AI or data centers or whatever. Or it could be a factor play like momentum or quality or whatever. Now, I guess there's some debate about whether this is an active or a passive strategy. It lies somewhere on a spectrum, depending on what the fund actually does.
Yeah, it certainly blurs the lines. And I think thematic factors, the risk is always that you're going to overpay because you won't be the first person to notice that the theme has outperformed. And of course, money flows into the fund once it does start outperforming. But history's littered with the wrecks of thematic funds which just stopped outperforming because the theme just became irrelevant.
And the thing with factor funds, like value, momentum, quality, and all that stuff, is that you can do it in a kind of passive way where there's a filter that's defined and it picks the stocks that meet the guidelines. But even if you go for an active fund with a manager who's picking stocks, often they will have a kind of implicit style which marries up to one of these factors, and they're trying to beat that factor in effect.
Yeah, so there'll be a value investor where they buy relatively cheap stocks compared to fundamentals, or there'll be a quality manager where they go for stocks which have good fundamentals like good earnings growth, not too much leverage, good return on equity. Terry Smith would fall into that category, I'd say, or some combination of those factors. So it's often the case that if you can work out which factors the fund manager goes for, you could probably replicate their fund more cheaply with passive funds which have these factor tilts. And I think it's a real question. Are these factor funds really passive at all? What you can say is that they're rule-based. It's not an active manager which is selecting stocks, but there is a selection process which blurs the line, I think, between active and passively managed funds.
Maybe it's controversial to say it, but I think almost everything blurs the line to a greater or lesser extent. Like people even say the S&P 500, for example, that famously passive benchmark, has a hint of active management to it. There is a committee there, again, working based on rules, but with some discretion, deciding what goes into the 500 stocks that make the index.
Yeah, you're right. There is. And although they're not really thinking about, will this stock outperform, which an active fund manager would be, they're thinking more along the lines of, does this satisfy the criteria based on liquidity, based on profitability, whatever their criteria are for their index? That's how they'll decide whether it gets included or not, or whether it stays part of the index. But you're right, I think it isn't all or none, active or passive. There are grey areas.
Now, there are ways of measuring how active a fund might be, and maybe that's something we'll come on to after the break.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 2-on-2 card, which has no FX fees, true interbank rates, and offers 1% cashback on all transactions up to £20 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 2-on-2 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code ROMIN. That's RAMIN within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 2-on-2 cards are issued by Paynetics, which provide all payment services. Trading 2-on-2 provides customer support and user interface. Terms and fees apply.
So we've talked about many of the different strategies that active funds might employ in the hope of beating the benchmark. But frustratingly, quite a number of active funds, or what claim to be active funds, are actually secretly just tracking the benchmark, again, to a greater or lesser extent. And one metric that is very useful when you're choosing an active fund is active share, which tries to untangle and identify these benchmark huggers.
So let's say you've got a US stock picking fund. It's actively managed and its benchmark is the S&P 500. Active share would be how much its weights, i.e. how much of each stock it buys in the S&P, would deviate from the market cap weighted index. Now, it might be that they just hold 5 stocks and they've got a huge position in those 5 stocks, and they'd call that a high conviction fund. Now, if you're choosing an actively managed fund, presumably you'd go for one which does have high active share. Whereas if it's got 0 active share, then it'll just buy the index.
But it'll still be charging you a chunky fee to do that because it's claiming to be an active fund.
Which is the worst of both worlds, right? You're paying active fees for passive performance.
The regulators are actually increasingly hot on this phenomenon, right? They don't like people to pretend that they're doing something fancy when they're not.
Yeah, benchmark huggers are really anathema to the regulators. Rightly so, I think. If you're going to get a big fee, you should be earning it. So this is a passive sheep in active wolf's clothing, if you like, because they're not generating outperformance. And in fact, they're just a passive fund.
Well done. You've added 2 more animals to our farm or zoo. Now, there's another metric which is in a way related to active share, which is tracking error. Now, you might have heard this in the context of passive funds, which simply means how well does it track the benchmark that it's targeting. And usually it's pretty good. Like, they'll almost exactly match the benchmark, but they might miss it in some ways because their buying strategy is not perfectly aligned with changes in the benchmark, or they're just sampling the stocks and that gives a small tracking error. But with active funds, tracking error means something a little bit different.
Another name for this is active risk. The idea is that you take the returns of your fund and you look at the difference between those returns and the benchmark and work out the volatility of that difference. So a bigger deviation gets a bigger tracking error. Now, for an active fund, you want it to outperform on the upside. So a bigger tracking error means that you have the potential for upside. Although, of course, tracking error on the downside would count the same way, because when you work out the volatility, you square the difference and throw away the sign.
That's exactly what I do, yeah. But what we're ultimately aiming for with an active fund is a higher risk-adjusted return than the passive equivalent, right?
So let's say we wanted to take a gamble with other people's money. I'm not saying active fund managers do this, of course, but let's say we wanted to do that. You get a big name, you get lots of money through the door, you take big bets, you'd have a big active share, maybe even lever it up, toss a coin, and then maybe you'll outperform or you won't. Some of them will outperform, some won't. And then if you do outperform, more money will flood in and you'll get big AUM fees because it's a proportion of the amount of money you manage. So there is an element of luck involved. And of course, what you should be looking at is how much risk did they take in order to generate that outperformance? And we'll come back to that in the dumb question.
Because investing is invariably a trade-off between risk and return. And yeah, they can outperform potentially by taking on more risk, but you could do that yourself more cheaply if that's all they're doing. So again, like we should be on the lookout for secret benchmark huggers, we should also be on the lookout for funds where all they're doing really is leveraging up return. The other thing I would definitely look out before I bought any investment really, but especially an active one, is the liquidity that the fund has.
And of course, there are two levels of liquidity. One is for the fund itself. Can you buy and sell it easily and cheaply? And then the other level of liquidity is the assets that they buy. Are they liquid or illiquid? And sometimes you'll specifically go for funds which buy illiquid things. And the motivation behind that would be that illiquid investments generate higher returns. You find that with infrastructure funds, property funds, private equity funds. All of these funds make illiquidity a virtue.
And in terms of the liquidity of the fund itself, what we really want there is to be able to trade it cheaply. And the way to measure that generally is a low bid-offer spread.
And for most large funds, the bid-offer spread will be quite small. If you're buying things like investment trusts, they're closed capital funds, which means that if people buy the fund, they don't generate more units as an open-ended fund would, as an ETF would. And if people sell it, they don't destroy units. And that means that they're not forced buyers or sellers of assets. So if they're holding illiquid things, I think investment trusts make a lot of sense. And generally, these tend to be quite liquid. The funds which tend to be most illiquid are the ones which are quite small. They've got a larger bid-offer spread. Maybe it's because they haven't been around for long. Maybe it's because they're not very popular. But whatever the reasons, that bid-offer spread can be large, sometimes percentage points.
Which is effectively another fee you're paying. You should think of it in those terms.
If you will be buying and selling a lot, definitely. And even if you don't, there will be an entry and exit cost due to that.
You kind of touched on something interesting there, which is that there's a difference between a closed-ended and an open-ended fund. So investment trusts, as you said, are closed-ended. But I just want to go back to open-ended funds where if loads of money starts piling into the fund, they've got to find stuff to buy, right? There's more money they have to put to work. And there are some situations where, let's say it's a fund that buys small caps. It almost makes their job harder, doesn't it, when money floods in? Because there's kind of a constraint on the stuff they can buy. Maybe they can only identify 20 like really undervalued small caps and they've bought them all.
Yeah, and then they'd have to broaden their criteria for which stocks they buy. And that would mean buying stocks which aren't as good, in their opinion. So yeah, success of a fund can itself lead to problems. And once funds reach a very large scale, then it can really restrict what they buy. Warren Buffett's the famous example of that.
I sometimes wonder if this lack of persistent outperformance for active funds can come down to this. Like it's just really hard to do the job when money chases return.
Yeah, in certain spaces, I think that's true. So, for example, if you go for European defence funds, there's only about 20 companies that you can buy. So that's a very restricted set of stocks.
Now, despite everything we've said, there are a handful of funds which can perhaps claim persistent outperformance versus their benchmark. Maybe we should just look at one example and talk through, well, how has it managed that and is it going to continue?
Yeah, I first came across these. Most of the things I learn nowadays are from the community, but people were talking on our chat application about these funds called Research Enhanced Index Funds, and these are from JP Morgan. Fidelity also has some of these. But let me just explain how they work and why I think it's kind of an interesting approach. First of all, it's not some person sitting in a room trying to decide which stocks are going to outperform. They take all of the research from their equity analysts. And remember that if you go to an investment bank, there's an army of these people. Single stock analysts from every sector, TMT, utilities, tech. A lot of brain power, a lot of PhDs going into looking at what the forecast profits will be for these companies. Then they sort these companies into quintiles, the top 20%, the next 20%, and so on, from best to worst. And then the approach is either to go overweight the ones which are good and underweight the ones which are bad, or if you want to generate income, You can sell call options on the ones which are supposed to be bad because they haven't got much upside anyway, in your opinion. And that way you can generate some additional income for the fund. But this research-enhanced index approach isn't just one person. That's the important thing, I think. Secondly, the fees aren't too high, so if there is a bit of outperformance, it's not going to be gobbled up.
Now, this isn't a recommendation, obviously, but let's look at JP Morgan's Global Research Enhanced Index Equity Active UCITS ETF, which has the ticker JGRE if you buy the sterling version. Now, it does exactly what you say. It uses all of JP Morgan's research to try and tilt the index in such a way that it's buying more of the companies that are going to do well. And the underlying index that it's benchmarked against is MSCI World, so that's developer markets. Now, one thing to note straight away is that they manage risk very carefully, and the beta of the fund is 1.
So let's just very succinctly talk about alpha and beta. The return of a fund, an active fund, say, can be decomposed into two things. One of them is how much the underlying benchmark explains of the return. So that's beta. So for a passive fund, beta is about 1. If the index goes up by 1%, your fund goes up 1%. To that, we add something which is called alpha, and that's the outperformance. So that can gradually increase the return of the fund over time relative to the benchmark. Now, for a passive fund, alpha is expected to be 0. For an active fund, you want alpha to be as big as possible. For a benchmark hugger, alpha would be 0 and beta would be 1.
Now, this research-enhanced index fund from JP Morgan has a beta of 1. So when the underlying index goes up or down by 1%, you should expect this fund to do similar. But it also has a bit of positive alpha.
So if we look over the last 5 years, I can see that the beta is 1.00 and the alpha is 0.61. So that's a small outperformance of 0.6% a year, I think.
And that is net of fees. Now, the claim that the portfolio managers make about this fund is that it could be used as a good replacement for your core equity holding because it's no more volatile than MSCI World, and it tends to do a little bit better. And in fact, that does appear to be true since the fund's launch. However, I can see when I look at the data that alpha seems to be shrinking over time. So as you said, over 5 years, it's about 0.61, but over the last 3 years, it's more like 0.25. So that's a big drop. And also the Sharpe ratio has come down and the information ratio has come down a lot, which we can touch on in the dumb question. But whichever way you cut it, the outperformance seems to be decreasing.
So I think this is really intriguing because I think this is a fund which could potentially outperform because the fees are low. I think the method of generating outperformance, which is the equity research desk at JP Morgan, is a thing which will persist forever as long as JP Morgan exists. The quality of those ideas, again, I think will be fairly consistent over time. But have we had enough history to gauge whether this thing will carry on outperforming in future? I don't think so. I think you need at least 5-10 years of outperformance, where alpha, of course, will vary. Sometimes it'll outperform, sometimes it won't. But that's what you need to really gauge whether this approach is going to work. But I think if anything has a chance of consistently outperforming, it would be this kind of approach.
Now, I watched an interview with the fund manager who would push back on that point about a short history for this fund. Yeah, this fund itself has a short history because it was only made available to retail investors in 2018. But she made the point that JP Morgan has been running research-enhanced index strategies for decades, like 20, 30 years, and they're pretty confident that it has outperformed over that time. I guess we take them on their word.
Well, they would say that. They wouldn't say, oh, actually, it's a waste of time.
Now, we've talked about alpha and Sharpe ratios and all that stuff, but how has this fund actually performed? Well, since launch, the underlying benchmark, which, as I said, is MSCI World, has returned 11.49% annualized, whereas this JP Morgan fund has done slightly better, 12.27% annualized. And they've got a nice graph on their fact sheet which says if you bunged $100,000 into the fund in May 2020, so 5 years ago, that would now be worth almost exactly $200,000, whereas the underlying index would just be 194,000. So, yeah, there is a bit of outperformance there. The question is, will that keep going?
Well, in order for that to happen, JP Morgan's research desk would have to carry on generating good ideas, which are correct. And markets would have to respond to fundamentals. Remember that for many stocks, they don't. Just look at Tesla, for example. So if we do have irrational markets which really aren't responding to fundamentals, which you can do for short periods of time, then this thing will not outperform. But if A, analysts at JP Morgan get it right about future earnings growth, and B, markets are being rational, then yeah, you'd expect this outperformance to continue. But that's a big if, and I'm not convinced that they'll be able to do this year in and year out. But if they did, then it would be more likely to be sustainable than some person sitting in a room trying to come up with alpha-generating ideas.
I mean, it has underperformed over the last year, returning 11.6% versus the index's 13.7%. And I think the key thing for me is the pitch is you could use this to replace your core equity holding. Personally, I wouldn't do that. I'll stick to passive. But if you were to do that, yes, you have to believe JP Morgan can keep coming up with the right ideas and implement them consistently. But crucially, you also have to believe that they will keep a really good handle on risk here and keep that beta at 1. And yes, you want them to take the tilts that are going to outperform, but you don't want them to go overboard, right? Because if they're wrong, you don't want your underperformance to be too big.
And there I trust them more. I think professional fund managers can be relied on to manage risk very effectively. Managing alpha is next to impossible because it's so difficult to generate. Okay, I think it's fair to say that we're both a little bit cynical about the ability of this fund to outperform. But let me throw this one to you, Michael. I recently did a portfolio critique for a member who'd bought a fund JEQP, again from JP Morgan. But this one generates a lot of income by selling upside calls on the stocks which their analysts think won't outperform, which are part of the NASDAQ. Now, this is kind of like another covered call fund, QYLP, which sells the upside on the NASDAQ as a whole. There's a big difference between those two. Both of them generate enhanced income, so you can generate, 12, 14% dividend yield on the NASDAQ. But for JEQP, if they're right about the stocks which don't outperform in future, then you're selling upside which doesn't matter, which is never going to materialize. So what do you think about that? Would you go for this kind of actively managed enhanced yield fund?
Okay, you're giving me a live on-air financial advisors exam here. Let me guess. My guess is you're relying on them to pick stocks in addition to the covered call strategy. So as much as I don't want to do the covered call strategy, I think I especially don't want to do one with a stock pickers overlay.
So that's a resounding no then.
Am I right or am I wrong?
There is no right or wrong answer. I think it really depends on whether you think the extra income is going to be worthwhile, and also whether you're going to keep the upside of the NASDAQ, because of course that's the big appeal of these funds. You can keep some of the upside, and you won't have sold all of the upside for the index, assuming they get the names right.
I think the evidence is that in the long term, the covered call strategy, as much as it might generate income, the total return will underperform the index.
Yeah.
Well, I think it's time we started to wrap this up. We've talked through a lot of different strategies that active fund managers use to try and beat the market. But is all of this going to be very old hat very soon? I've noticed that in the media, there's increasing talk of AI-run funds, like quant funds that are run by machine learning algorithms. And it seems that even some of the skeptics of this approach have started to get on board. So Cliff Asness, who co-founded AQR Capital Management, which is a big quant group, even he is now saying, and I quote, "We're surrendering more to the machines." There was a good article in the FT recently.
So again, history's littered with quant funds, which have effectively run money with algorithms and which have blown up time after time. So hopefully this time will be different when it comes to AI. The models are now more sophisticated. It is still a black box. Often it's the case that the fund manager doesn't understand why the AI is doing what it does, which is worrying.
Well, I don't understand why the fund manager does what they do. So from a buyer's perspective, the black box is still a black box.
I'd rather have a fund manager that underperforms for reasons they can explain rather than reasons they can't explain.
Were you satisfied with Woodford's explanation?
It's the market's fault.
I don't know. As I said at the start, active funds are not something I typically buy, and I don't think that's going to change soon. What about you? Are you going over to the dark side, Romin?
Well, I do have some active funds, but they're only in my fund portfolio. Scottish Mortgage is the one I've held for ages. And I buy it because it's got nerdy, techie holdings, not so much because I think they're amazing fund managers, although they are very good. Of course, they are world class. Baillie Gifford's a very good fund house. But look, for my core, no, I buy passive funds, and that's always going to be the way I go, unless there is overwhelming evidence to the contrary. And it is an evidence-based approach. I mentioned that it's often members who inform me about changes in the market and innovations. Well, you could be a part of that community and benefit from speaking to them directly. To learn more about that, just go to our website, pensioncraft.com/membership. And during the month of June 2025, we're offering a 75% discount for new members on your first month's membership. There's a coupon, SAVE75, all one word, all uppercase, and use that at checkout.
Okay, today's dumb question of the week. What is the information ratio and why does it matter?
So this is what we'd call a performance measure, which is risk adjusted. That's to say that you look at the outperformance relative to a benchmark. But remember we said about taking a lot of risk or not taking a lot of risk relative to that benchmark. You adjust down the return by the amount of that risk. So it's defined as the active return, which is the fund return minus the benchmark return, divided by the tracking error, which is the volatility of the fund return minus the benchmark return. So how many units of outperformance do you get for every unit of risk you took?
And so this information ratio, I presume, is a good way to compare between different active funds and saying, well, which are actually generating excess risk-adjusted return over their benchmark.
Yeah, that's exactly it. And this will really weed out those funds where they do just lever up and take a lot of risk without generating a huge amount of outperformance.
Now, there are other measures of risk-adjusted return. The one you commonly come across is the Sharpe ratio. How does the information ratio differ from the Sharpe ratio?
It's also a risk-adjusted performance measure, but instead of benchmarking against a fund, a passive fund or a benchmark like the MSCI World, you're benchmarking against the risk-free rate. So it's like saying, if I don't put money into a money market fund or a very short-term gilt, what return will I get in excess of that risk-free rate, divided by the risk I've taken?
Yeah, so as I understand it, the Sharpe ratio is kind of measuring the total risk involved, as you say, comparing to the risk-free rate, whereas the information ratio is trying to winnow that risk down to just the sort of active risk that the manager is taking over and above the benchmark. Because the benchmark of stocks already involves a fair slug of risk.
Yeah, so it's like saying, compared to something very low risk, almost zero risk, or as close as you can get, what return have I received? So really it's the benchmark, it's the comparison that varies between the two.
So the Sharpe ratio might be good for comparing between all sorts of different investments and different assets, whereas the information ratio is just very good for specifically looking at active funds and whether they're actually adding value to your portfolio. And in terms of both of these, higher is better, right? We want a higher Sharpe ratio and a higher information ratio.
And the longer the period of time you can calculate it for, the better, because it could be that they've just been lucky and the outperformance was transitory.
The other thing I like to keep an eye on is, are the Sharpe ratio and the information ratio stable or are they falling over time? Because there's this concept, isn't there, of alpha decay, which is incredibly important when it comes to active funds.
Yeah, often these ideas have a shelf life. It may be that the style of investing just stops working, or it could be that there's just been a period when a particular style did well, which may never be reproduced in future. So that's why I think you're right. I think the longer the comparison period you can do, the better. Ideally decades, but of course, if we're talking about active funds, it depends on a certain group of people being in the company, making the decisions in a consistent way.
Even if you have decades, right, the average doesn't tell you everything. You want to break it down and look at what's happening to these ratios over time.
Yeah, and they can decay, you're right.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.